Welcome to The Explainer. Today, we're going to use slides to get to the bottom of something big. A $40 billion a month controversy brewing at the Federal Reserve. And yeah, it's definitely got Wall Street talking.
All right, so let's just jump right into the big mystery here. You've got the Fed, America's central bank, injecting billions and billions into the market every single month. But they are absolutely insistent on one point. This is not quantitative easing. You know, the QE we all heard about. So if it's not QE, what in the world is it?
Okay, so to really get why the Fed is doing this and why it's so controversial, we've got to rewind a little bit. We need to look at this really weird, kind of worrying signal they were seeing in the markets. And this right here, this was a huge red flag. Look, the Fed did its job, right? It cut interest rates 3 times to make borrowing cheaper. But the market just wasn't playing along. The cost for the government to borrow money kept going up. It's like the Fed was flooring the accelerator, but the car just wasn't going any faster. Something was off. So because of that weird signal, what the Fed did next was, well, it was a scramble. It was a super fast series of policy changes that honestly felt a little frantic. And just look at this timeline. The thing that's so wild here is the speed. I mean, we're talking about a single quarter. The Fed went from tightening, that's quantitative tightening, or QT, where they're pulling money out, to a complete 180. All of a sudden, they're launching a new program to pump money back in. That's an incredibly fast pivot. Yeah, like turning a car sharply without hitting the brakes. I mean, that quote just nails it, doesn't it? See, central bank policy is supposed to be like a giant cruise ship. Slow, steady, predictable turns. This was like a speedboat doing a hairpin turn. You go from draining the pool to opening the fire hydrants, and it gave a lot of people on Wall Street some serious whiplash. So all of this scrambling, this hairpin turn, it all led to that last item we saw on the timeline, the launch of this new thing called the Reserve Management Purchase Program, the RMP. And this, my friends, is the famous not QE. And the second they announced it, the debate just exploded. What is the Fed really up to here? Okay, so what is this RMP thing? Basically, the Fed is buying short-term government bonds to pump cash right into the banking system. Think of it like this. The Fed goes to the banks, says, "Give me your bonds," and in exchange, they hand over a big pile of cash. The Fed insists, "Hey, this is just a technical fix. We're just greasing the plumbing." But the critics are saying, "Hold on a second. That sounds a whole lot like QE." So here's the Fed's whole argument boiled down. They say, look, QE was about buying long-term bonds to boost the whole economy during a crisis. But this new thing, RMP, that's about buying short-term bonds to fix a very specific technical problem. But you know, the market's reaction is kind of like, yeah, we hear you. But at the end of the day, you're adding a ton of money to the system. So if it looks like a duck and quacks like a duck, they're calling it QE in disguise. And you know, a huge reason why everyone's so skeptical is this feeling of déjà vu. It's like, wait a minute, haven't we seen this movie before? Because, well, we have. This exact same thing happened back in 2019. I mean, just look at this comparison. It's pretty hard to ignore, right? In 2019, you had market stress. The Fed jumped in with bond buying. The Fed insisted, nope, this is not QE. And what was the result? The stock market went on a tear. Fast forward to today, market stress, Fed bond buying, Fed says this is not QE. The parallels are just striking. It's the same playbook. And that 2019 incident is so important because it's where this whole thing stops being just a technical, nerdy debate about bonds and becomes really political. It raises some pretty uncomfortable questions about how independent the Fed really is. So here's the backstory you need to know. That 2019 not QE thing, it happened right after the Trump administration had been publicly leaning on the Fed, really pressuring them to lower interest rates. So when the Fed did this, a lot of people saw it as them caving to that pressure, finding a way to give the White House what it wanted without saying they were. And that history, it casts a long shadow. It makes people ask, is this new program just another case of the Fed bending to political will? Okay, so we've got the technical details, we've got the politics, but what does it all mean? Why should you care about any of this? What's the so what for the markets and for your investments? It all comes down to this number, $40 billion. Call it what you want, RMP, not QE, a plumbing fix. At the end of the day, the Fed is injecting $40 billion of fresh cash into the system every single month. And that brings us to what we call a liquidity-driven market. Look, when you have that much cash pouring in, it has to find a home. And a lot of the time, that home is the stock market. That money can push asset prices up and up, even if the underlying economy or company earnings aren't looking so hot. And this is really the key takeaway here. Just like that quote says, the big market rally in 2019, it wasn't really about fundamentals. It wasn't because companies were suddenly making way more money. It was driven by all that liquidity the Fed was pumping in. And so the big question on everyone's mind now is, are we just watching a rerun of 2019? So this leaves us with one final and really important question to think about. Are the Fed's actions, this not QE stuff, actually just fueling today's market at the expense of something much more valuable? Their trust and credibility for tomorrow. It's a massive $40 billion question, and frankly, there's no easy answer.